Hey, good afternoon, everyone. This is Lane over here with Credit Suite. Just hopping on over here for today's training video webinar. Let me actually run through my quick checklist house cleaning just to make sure that I've got my information set up here, and it looks like video and mic and everything's working on it. So hopefully that works. And oh, I remember from a past presentation, I forgot to pause my notifications. So I had a bunch of notifications coming through during the time. Let me make sure those are paused, which it looks like they are. Fantastic. As you can notice, I know some of you probably have been attending these webinars here before, and oftentimes they're presented where the presenter will be Ty Crandall. I am not lucky enough to be Ty Crandall. My name is Lane McGleston. I've worked with Ty for the past 10 plus years in the business credit arena. He's actually currently attending CreditCon down in Clearwater, Florida. So he is actually at a live event, which we're actually super excited about because live events are coming back. So this is one of the first live events that we've been able to attend as a company with some of our employees there. And we're hope that it will continue just like it's been in the past. But today's topic is about business funding, even for a startup company. Now, I like to break this topic really into two categories before we jump right in here to the PowerPoint presentation. The PowerPoint presentation really has half of it is dealing on what's the process of starting a new company, which might be a review for many of those who are out there who have attended our webinars before. And then the second half is going through funding options, some funding options that you might have been aware of, other funding options that you might not have been aware of that you can do even with a startup company. So that's something that we'll fit through. So halfway through it, we're going to kind of switch gears, and we're going to go to the point where we can, here, pause for a moment here. Got a little 2-year-old who likes to be able to come in and be able to interrupt me right when it's the most important moment, but it's all good. So halfway through the presentation, we're going to switch gears and go on to the funding options and kind of review. It's really going to be an overview of the different products and services that can be available even for startup companies. Definitely more detailed information would come from our funding team or an actual funding rep, but we want to kind of cover that good overview just so that there might be funding options that you might not have been aware of overall. So let me click on this PowerPoint presentation and see if we've got things set up in here going. So there's Ty Crandall. So starting off, we're going to start with initially just dealing with what it takes to start a business. Now, starting a business can be very exciting, but most businesses, I think all of them, will need money to get started. So if you're new or you're starting a company, usually all starts with the same aspect where they haven't generated any profit yet. So you've got to be creative with funding and how to be able to get that funding set up. But it all starts with the fundability. The fundability I like to describe, if those out there have to deal with blueprints or with real estate, the fundability really is the foundation of a business. The same way you would have a foundation for a house, it really comes to that fundability. These are available for business, and that foundation will determine what you're able to get in funding later on. So it's really essential to cover all the points that a lender is really going to be looking at to be able to provide funding for your business. So when they're trying to figure out if basically you have to think like the lender, a lender is just trying to mitigate risk. All they're trying to determine is, are you a good risk or not to be able to pay back a loan? So that's what a lender's looking for. So they're just trying to literally figure out, is the loan going to be paid back or not if it's extended to you? So these factors, you probably may or may not have an opportunity to think through yet. It all depends if you've been following us online and seeing our past training modules. If you're new to here, then some of these fundability factors might be a surprise to you. So number one is your business name. So your business includes does your business name include something that's considered a high-risk industry? Now, a lot of industries nowadays are risky, but they're not considered restricted or a high-risk industry. So even if you look on some categories that are out there, credit repair companies or real estate or even a barbershop or a salon can be considered risky, but they're not considered restricted or under that high-risk category. To quickly go through what a restricted industry is, those are typically like a nightclub, gun sales, alcohol, medical marijuana, adult entertainment, type of businesses that focus on like human vices. Those are ones that turn around that banks still considered are restricted. Most every other business though can still fit in the category of building business credit. So did you happen to know that your name and the industry can keep you from getting funding? It does, but it doesn't have to necessarily be that way. So you don't have to include the name of your industry in your business name. There's nothing deceptive or illegal about the process. You can name your business anything you want, and in some categories, you might want to just keep it more generic. So in this example, you can actually just name your business Jane's rather than Jane's Trucking, which specifically points back to the industry. Now, you do want to consider for marketing purposes that if you want to let people know what you do, for marketing purposes, it might be important to actually include that in your business name. Other factors on your business name, you want to make sure that they're uniform everywhere. That would include like the Secretary of State, EIN number, bank account with all your accounts. You want to make sure that all of these have been updated with your incorporation paperwork, licenses, records with your credit reporting agencies. So through this webinar, the CRSs are referring to the business credit reporting agencies. In this case, we're going to focus on the top main three: Dun & Bradstreet, Experian, and Equifax. Also, other factors to be considered regarding on your business name is as you're updating that, it's best to even just copy and paste from like an existing file that you have that you know was 100% correct. That way there's less of an opportunity to mistype that name overall. Making these this is because differences will interpret as fraud. The reason why this is important is because if there are differences, business lenders will determine that as fraud. Even with Dun & Bradstreet and Corporate Experian, they'll report your information based on your business name and your business address. So if your business name happens to be a little off just because of a typo, they'll actually create a whole nother file, or they won't realize how to link those together. So this way you can keep your record of where your business name is so you can ensure that it is correct with everything. You're also on your business name, it's important on a startup to presumably there are fewer places you'll need to keep track of it just because you're getting startup, but that number will grow as you gain and establish other accounts. So simply be organized from the beginning with a system in place to keep that organized as you start going through that process. And something that's manageable. You can even create an Excel spreadsheet so you can have all your business account information so you know where everything's currently reported. It's funny, on a number of times where I talk to individuals and they're we're talking about their credit card information, and when it comes down to, if their billing address, they'll say, actually, I have no idea what it is, because they have different addresses, different virtual offices, residential or not. And they're like, gosh, that's a good question. I can't remember. And honestly, when I think about it myself, if someone asked me, I'd be like, gosh, man, I think on a couple of my credit cards, I might not have updated it. So it's important to manage that and keep that available. Now, many of you have probably heard of an SIC code. There's also, and for some reason, I think we left it out on here, there's an SIC code or the NAICS code. These are basically code that's given to the business industry. The reason why they did this is because computers can't necessarily recognize if you just put in trucking, it doesn't necessarily recognize the word, but if you put in a number, then the banks can actually associate lending purposes based on that number. So you want to make sure that you pick a good SIC code or NAICS code. This code is an industry code that businesses use regarding the activities that the businesses are primarily engaged in. That NAICS or SIC code also have the ability, they basically list every business industry that's out there. So you want to make sure you're picking one that doesn't have as high of a risk or high cash industries. So the higher the risk industries are, like what I mentioned before, casinos, pawn shop, liquor stores, adult entertainment, gun sales. Medical marijuana is one that's kind of on the fence for those who are looking into that industry. Even though it's legal in many places here in the United States, the concern is lenders don't necessarily have to follow the guidelines, so they can still have it as a risky or restricted industry. If more than one code would apply, there's nothing deceptive or illegal or wrong with using a less risky code. So for an example, say for an example, you're specifically doing in real estate and you're dealing with fix and hold properties. You can have a number of properties, but real estate in general is considered a risky industry, but the category of business management is less risky. And there's nothing deceptive or illegal or wrong that if you happen to choose an SIC code that's business management in comparison to specifically real estate. Reason being is that if you're managing properties or managing your business, it could still fall into that category. Now with lenders, just as a heads up, this is a small percentage of the process of getting lending. So just because you pick a less likely number doesn't guarantee you're still going to get funding. The lenders have become more savvy and smart in these last few years, so they look at more categories to determine more about your lendability. But this is just a piece of the puzzle. That's what we're trying to go over here. So other factors regarding these SIC codes or the NAICS codes is the IRS, lenders, banks, insurance companies, the credit reporting agencies, they all will look at that code. They're simply trying to determine if your business is a high risk in a high risk classification category. So some cases that you can get denied for a loan or business or even a credit card just based on that classification. Some codes can trigger automatic turndowns, high premiums, and reduce credit limits for the businesses. Here's actually a website that you can go through where you can actually put in your business description, like say real estate or trucking, and then it will actually pull up an SIC code or an NAICS code. Another website, I don't think that we have it right on here, is www.siccode.com. So that's another reference that you can look at, and it will actually refer to both codes. So you can pull up your SIC code and then it will give you the corresponding NAICS code to go with it. And I believe here at NAICS.com, it does the same. So you can actually look back and forth. Why there's two, I think way back when they started it, there was competing companies and they created their own system and they've both been around, but banks and lenders both use them today. Now, business entity type. To get financing, you want to make sure your business has a credible business entity. This would be in the form of a corporation or an LLC. That just simply helps reduce your liability, and it also allows you to separate yourself from your business credit, and it's a legal entity. So make sure these entities are set up in the same state as where you're registered in your business. Follow-up question on here, if those who are operating out of a different state from where you're registering, the way to be able to calm the risk level of a lender is by foreign filing. So say for an example, you filed in Delaware or in Wyoming, but you happen to be in New Jersey or might be in New Mexico or something. What you can do is foreign file your entity in the state you're in. So when the bank goes for verification, they can still see that your business is a legit business. EIN number, or your employee identification number. This is issued to you by the federal government. It's a 9-digit number, similar to like a social security number follows you personally. This is your, in a way, social security number for your business. You want to make sure that that number's been established with the correct address and name, and it's going to be used in getting your business checking account established, and it can help build up your business profile overall. So make sure that with all the foundation steps, that you're verifying all the agencies, your banks, your trade credit vendors, that they all have the same information, including that EIN number. If the numbers or if the information misses, what happens is the lender will usually just either give it an automatic decline, or it will go into a manual review rather than letting their computers give it an automatic review or automatic approval. Other issues that are dealing on that funding would be your address. So a business address should be linked to a brick and mortar building. Now, this is a topic that has changed recently in the last year due to many home-based businesses. In the past, this was truly the case, but we have noticed that lenders have become a little bit more lenient when it comes to residential addresses, just because of people being locked down. Now, we're curious on what's going to be moving forward if the lenders are going to change and go back to their have to have brick and mortar addresses. But at least for right now, both, as long as it's a physical address that really looks like where you're doing business, it's a good place. The places to stay away from would be a UPS store or a post office box or even iPostal. Basically, if you do a Google search for the address and it actually looks like a post office box or on a strip mall where it's an iPostal or a UPS store, lenders will know that that is not a place you actually are performing business. So they'll definitely be worried. Business phone number. A cell phone or a business phone number can be used as your main business line. It could get you flagged if it's your home number or a personal cell phone number. But if you have them established in your business name, it's different. Reason being is when it's listed in 401 directory, you can actually have your business name and information listed and attached to that phone number and the address. And again, it's all just making sure that things are uniform. You shouldn't give out your personal cell phone number or residential number as your business number. You want to make sure you make that step and get the business number established and have it be listed in 411. There's a higher likelihood of you getting approved for funding when you're applying. So make sure you check your records to make sure that you are listed and that the information is correct. There is a helpful website right here called listyourself.net. If you don't have a listing, you can go through that website and actually get your business information listed. And more, there's information where you can get listed like with Google Maps and Google Sites. So if anyone does a search for your business, you have a presence online. The greater the presence you have online, even with Facebook accounts or Instant Grant accounts in your business name, what will happen is the lender's risk level will basically decrease, and they'll say, hey, this is a non-risk business because it looks legitimate. So the more you're able to have your company look and operate the way a company should look and operate, the greater chances of lending that you have. You could also have a toll-free number, which is okay. Business licensing. Want to make sure you have proper licensing for your corporation. Make sure the address and name matches as well as on all the other documents. It could be issued through your state, county, or even your local government, city governments. So there is some research that's involved when it comes to licensing to make sure that you've got the proper licensing from each of the respected government agencies. In some cases, the most common license that you can have is an occupational license. And that is where from your local city or county, if you have a physical location where you have clients or customers who are physically coming there, they want to make sure that the location is safe for these customers or clients to enter your premises. So they'll make sure you have proper things like fire extinguishers and proper railings, and that things are safe for people to come and visit overall. Other type of licenses that come through is like if you're a trucking industry, you have to have the proper CDL driving license. But then if you're a professional, so it moves up like an attorney or a CPA, those have licenses that are required for from the state level or government level to be able to operate. So just do your research to find out if your particular business needs those licenses or not. And then once again, the foundation step is make sure everything is uniform, that proper address and information are in there. So then that way, your name, your address, your phone number matches across the line. Website and email address, make sure your company has an email address for your business as well as a domain name that can be connected to your website. Use something that's professional. It's just making sure that your company looks good, such as an example here, your name, support, or information at whatever your domain name site is. It doesn't have to be your business name. Your website doesn't, but you might consider that for marketing purposes. What you want to try to stay away from is email addresses that are connected back with specifically AOL, Yahoo, Gmail, Hotmail. They're just less professional. Now, clients can still get funding even if they don't have that website set up into it. There's items on the foundation that are kind of mandatory, and then there's items on the foundation that are highly recommended. So this is a highly recommended, but it's not like an EIN number or a bank account where those ones are basically mandatory for operating a business. Now we're going to take a switch. Sorry, I went through that pretty quickly because I know we've done a number of webinars about foundation and how a company should look and operate when it comes to the fundability of a business. So I want to switch gears here and get into different funding availabilities that come for even a startup company overall. So the main thing to think of is when it comes to a business has 3 C's of being fundable. This is what a lender really is looking at. So again, you want to put on your lender hat and you want to kind of think like a lender to determine if a business is able to get funding. So let me go through these really quick so you have an idea and see them. Here are the 3 C's of credibility or getting capital for your business. The number 1 is cash flow. I think this is the number 1 thing that lenders look at to be able to determine how viable a business is. And they'll do verification based on your bank statements or even tax returns. So sometimes they'll ask for 2-year tax returns. Some lenders will look for 6-month bank statements or 12-month bank statements. It just depends on your lender. Now, the reason why this is big is they've determined that past performance of a business will determine future performance. So if they're able to look at your past 12-month bank statements and see that your company's doing, let's say, $20,000 per month in revenue, they have a pretty good idea that the next 12 months you're probably going to be doing something similar or more. So that's why cash flow is important. The third on the list is credit. Credit can be in the form of business credit or in the form of personal credit. So it could be both. Credit could be established through either where you can build up your business credit just focusing on your business or piggybacking off of your personal credit history. And then there are different criterias that the lender are looking at based on both. The third option, or the one that's right in the middle, is collateral. Collateral, probably the easiest example of a collateral-based loan would be real estate. Basically, they're saying we're going to have a lien or we're going to have the property be the collateral based on the loan. So if the lender has a risk or an issue or something goes south when it comes to the lending, then they know at least they can go back and get into the collateral. So those are the main 3 categories when it comes to getting business lending. Now, when it comes to personal credit, typically the lender needs all 3. They're looking for good personal credit, they're looking for your cash flow personally, and they're looking for collateral in the form of like the car or the real estate or the boat or whatever the equipment is that you're lending. And they're going to look at all 3 to give it. When it comes to a business, you can actually get lending based on each. It doesn't have to include all 3. So you can get a collateral-based loan regardless of your business credit or cash flow. You can get a cash flow loan based without worrying about the personal credit or business credit, or you can get business funding just based on credit. So it does open up more opportunities. So with that foundation, let's shoot through these different options. And just as as a side note, in case in the future you want to revisit this information, if you go to creditsuite.com and then you click on business funding under our menu bar, we have these options listed as well with a little more detail than the criteria that I have in the website. This is kind of an overview. So if you're taking notes or jotting down, yeah, remember creditsuite.com. And then if you go to business loan under our menu bar, you'll actually be able to see these categories again with a little more detailed information. And they have even like individual videos teaching you about each of these funding products. So that's a great resource that's on here. I think we handled all of this. Acquisition loan. Okay, so here we go. Vendor credit. So the first type of credit that you can establish for a startup company specifically is with vendor or store accounts. This falls under the category of business credit. So these would be business credit with vendors like Home Depot, Walmart, Costco. These are vendors that are open to working with most businesses, even brand new startup companies. These ones also, many of them will report to the business credit reporting agencies. Not all of them do, but some of them will actually report back and give you that. Most vendors will report to the credit reporting agencies within a 60-day time frame. It all depends on their billing cycle. Most of them are on a month-to-month, so depending on when you made the purchase will depend on where it actually is reporting back. Other vendor qualifying, it all depends on the vendor. Each vendor has their own independent qualification purposes. The majority, honestly, will look at a net 30 account. Some will look at your personal credit and some will look at your cash flow. Majority will look at your business credit prior history to determine what you can get approved for. So they'll look at Dun & Bradstreet, Corporate Experian, and Corporate Equifax, and based on your past performance with other vendors, they'll give you an approval. That's a quick rule of thumb of how a vendor works. Retail credit. Retail credit are major credit cards that come from these vendor and store accounts. For an example here, Staples. But everything from office supplies to power tools you can use, and they check your business information to make sure that it's uniform everywhere. They'll also check your business to make sure it's properly licensed. So kind of the steps that are involved when it comes to these vendor accounts. First is a vendor account where you can get credit specifically for products and services. Then after history, you can get up to even a retail credit with these store accounts where you can even hold a balance from them from month to month. And then a few of them have the ability where you can even get it to where you can get a credit card, and those credit cards can be used anywhere like Visa and MasterCard are obtained. Other terms and qualifications for these retail calls, they want to, again, it really varies depending on each of the store accounts. They might have a minimum time in business required overall or a minimum number of employees that can be verified on your Dun & Bradstreet account. You can actually put that information on there, or they might have even a minimum annual revenues that are required. Some of them will only accept the information on your application. Others will actually ask for documentation. So it depends. Some of them you can just put it as a stated loan. Others are going to actually look for that that documentation to determine. So as you do, you'll need at least 3, even 5's better accounts reporting to your business credit reporting agencies, because that can help give you that foundation on reporting business credit. Another type of account are fleet credit cards. This is used specifically to purchase fuel. They're very similar to like a vendor account where you can purchase products and services, but this is specifically for fuel accounts, like from Flying J or Love's as example, or Speedway. It can also be used if you need for repairing vehicles. It all depends on if that's the service that that particular station would provide. So even businesses that don't have big fleets could still actually get fleet gas cards for their company. And one of the great things, I actually always recommend the fleet gas cards, is because they all have vehicles and we all purchase gas on a month-to-month basis. So it is a great consistent way to build business credit, because every month you can be using your gas purchases to build up your business credit, even for initial startup companies. Some of the terms and qualifying for these fleet, Again, it all kind of depends on the specific vendor overall. They might also require a minimum time in business. Your business doesn't have to make the time and business requirements you may need. If your business doesn't make the time requirement, they might need to offer a personal guarantee, or even in some cases, a secured deposit as well. Basically where you're leaving a deposit because it's bringing the risk down to the lender. So then that way they have a deposit on file. So if something goes wrong, then they know they have something to go back on. This leads us all the way into the bank credit cards. Now, bank credit cards can be established with the personal guarantee or without the personal guarantee. It just depends, again, on one of those C's, credit. So it's going to be on personal credit, or if your business credit has been built up strong enough. So business credit cards can come from a universal type of credit cards like MasterCard or Visa or American Express. You can use them pretty much anywhere that they're accepted. These cards often will have reward programs as well. So some of the qualifying requirements for these can be based on terms that are revolving. Usually you need to have 14 reporting accounts on your business credit reporting agencies. So that includes, like the Home Depot and the Walmarts and the Costco. You need to make sure you have 14, 10 to 14, but if you have 14, then there's a higher likelihood of getting these approvals because they're going to base it on that prior history. The longer time in business definitely helps out, and there might be a number of employee requirements. What we have as a product here at Credit Suite is a program called a Credit Line Hybrid. It's a way to be able to piggyback off of the personal credit side to establish business funding in the form of unsecured funding. Now, what an unsecured business credit card is basically they'll give you an approval where you don't have to leave a deposit. It's going to be just based on your credit. So you can have a secured credit card or an unsecured credit card. Secured is when you leave a deposit. Unsecured is where they'll give you an approval just based on your credit history. So for those who haven't heard those terminology before, that's a way to better understand the differences between those times. So what our Credit Line Hybrid does, it's a way to basically have interest rates that secure a loan. It's a high loan amount in the form of business credit cards, and they start off with a zero introductory rate based on these approvals. And many of these will report back to like Corporate Experian or Corporate Equifax with the reporting agencies. So that way you can actually build your business credit with these credit cards at the same time of actually getting business cash funding options. Many of them, depending on that strength, will or won't require that personal guarantee. So here's some of the qualifications for qualifying for this. You do need to have good personal credit scores or a guarantor that is willing to use their good credit to apply for this funding overall. Typically, scores of at least 680 or higher. Right now, currently, and this is June 2021, so things can change depending on when you're listening to this video in the future, but currently we've noticed lenders are really looking for 700 and higher. 680 was in the past, right now 700, but we are expecting that in the future, as things kind of calm down in the lending worlds, that they'll go back down to 680. But that's just kind of a side note for past, current. It can change on what the lender's looking at. And you can often get around 4 to 5 times the amount of whatever your primary revolving personal credit card amount with is. Now, normally the question that immediately comes, what happens if it's just authorized users? Now, in the past, authorized users were used to determine what you can get qualified. They aren't currently used. They can help boost your score, but they don't boost your approval amounts. So if you had 10 authorized users and you applied for a business credit card, unfortunately, you wouldn't get approved. They're looking for a primary account. They want to see what you've been approved for before. And then that's what they based your approval amounts for this program. You can even get up to 150,000, but that, using the math, if you work backwards, the 150,000 divided by 5 would be 30,000. So to obtain that amount, you would need a primary credit card with at least 30,000 reporting on your personal credit, and it needs to have been reporting for the last 4 to 5 years. They want to see that history. So the next funding option that can be out there, even for startup companies, would be equipment leasing. You can also lease equipment rather than buy it outright. This is a way that you can put down, in a way, less money than you would if you were buying a piece of equipment. You may also be able to negotiate flexible terms with the equipment leased. It's easy to upgrade equipment after the lease ends, or look at the what the lease agreement is. In some cases, they actually have like a seller agreement or a lease to own rather than just lease. So if you're doing a lease to own, that way you're getting better terms overall, but then you have the option at the end of the lease to then purchase whatever that equipment is overall. It's helpful to, this is helpful if your equipment is sometimes like a computer, which quickly become obsolete. Then you can just lease it and turn it back to the company. But if it might be like a truck or trailer, it might be something that you're looking in ownership, but you might not qualify to purchase it out front. Here are some of the terms for qualifying for leasing leased equipment. The terms for these lease equipments, this is at least through Credit Suite that we have. You can be approved for equipment financing, leasing for as low as 640 personal credit scores. To get approved from a lender, you will need to request details on the equipment that you're getting. And then after they do a review, you can get approved on that equipment based on the business qualifications and what they're looking at. So they basically will take a snapshot of how your company is doing, revenue, down payment, and then they can determine that overall leasing. The next item on here is auto financing. Auto financing is when you're purchasing a vehicle, it can be used or new, and it will affect the number of years that you're financing the vehicle and the rates that you will pay. So if a vehicle is used, then the number of miles really will affect the terms of what you're looking at. New vehicles, low mileage already, so it has a different category. But if it's a used vehicle, they do look at how long that company's been, or that vehicle has been on the road. Plus, business owners may require to have a personal guarantee on these vehicle loans. It kind of depends on your business credit strength. If the business credit strength isn't strong enough, then they will refer back to the personal. Again, it's kind of like the credit cards you can get if you have 14 reporting vendor accounts, similar to auto financing. If you have 14 or so reporting accounts, then you can get auto financing without the personal guarantee. It might also depend on a cosigner if you have that case as well. Some loans do have a prepayment penalty, so you want to make sure you are aware of that. Auto loans are different than when it comes to like a mortgage. A mortgage, in the past, there were prepayment penalties, but then they changed the laws and basically said there shouldn't be any prepayment penalties on any mortgage, meaning if you want to pay off your mortgage sooner, you can without a penalty. But auto financing is different. They might require you to pay all the financing and all the interest on that loan. So if you pay it off early, you might still be paying off all the interest. So make sure you ask that question if you're getting auto financing. Other things to consider in auto financing is, in general, following will be eliminating the need to provide a personal guarantee for this type of financing with good business credit, or if you have a decent time in business, or if you have good personal credit. So those can really be the determining factors. Like much of the other lending options that are out there, business borrowing, it's more assured that you'll give the lender the better that they are going to issue you lending. So here's the bullet points for terms and qualifying for auto financing. You need to make sure that you have a certain amount down payment, which would be determined by the lender. They'll tell you how much you need, the vehicle you need, the cost associated by buying the vehicle, and then you need the documents to prove that you are the owner of the business. So those can be in the form of all those fundability items of a business license, partnership agreement, LLC document, articles of incorporation from the state. Some of them might verify even bank accounts as well, just to be able to determine that time in business and volume that's taking place. Other categories for auto financing, you might also have to provide your personal documentation, like personal credit scores or your credit history. If you happen to be a sole proprietor, and for those who aren't aware, there's different types of business entities that are out there. We spoke about the corporation and LLC, but you can also be a sole proprietor or just be operating as like a DBA. It simply means that you personally are doing business, but you don't technically own a business. So everything's going to be attached to you personally. So if you are a sole proprietor, the business is under your social security number, then you are truly the borrower who's going to be borrowing or the guarantor on that. Hence, you are personally liable for the repaying of the loan. Now, under a business, the business is liable, like an LLC or a corporation, liable to pay off the loan, but ultimately it's going to fall on that business owner as well. So the loan proposal should detail your business loan needs, your financial statements on what you're looking to accomplish overall when it comes to auto financing. Another category of financing that's out there that some of you may or may not be aware of is called 401k financing. Now, this isn't necessarily tricky. It's pretty cut and dry easy. They just have classifications on your 401k that you can actually use for lending purposes, but you just have to fit those qualifying categories. The biggest category to determine if you can use your 401k in lending is if it's attached to an employer or if it's a self-directed 401k. So if there is an employer who's contributing currently to your 401k, it's really not possible to go through this process. But if you have control, in a way, ownership of that, or it's a self-directed, then there are ways that you can do this lending. So in that, we can get through here with the details. So technically, it's not a loan, even though the best way to describe it to individuals is kind of in that format, but technically it's not. You will have the money, you will not have to pay an early withdrawal fee or a tax penalty because they've actually created programs for you to use this. You put the money back in by contributing back into your 401k. So this doesn't mean that you're losing your retirement funds. So, well, and it comes down to it where you have to talk to an actual CPA to be able to get these things kind of set up, or these lending institutions, to make sure that because you are taking money out, but you're paying the money back, but it's technically not a loan. That's probably the best way to kind of describe it. So the IRS calls this program specifically a rollover for business startups. Some of your other 401k programs will give other, like some will even allow you to take money out for educational purposes or if you needed to purchase a first home. So it kind of depends on what the uses of the money is going to be. But that rollover program that the government calls it, it's a qualified plan for separate entities with their own set of requirements. So the plan through a company's stock investments rather than the individual who owns or trade the business. Therefore, some exceptions for individuals may not apply to such a plan. This type of financing isn't a loan against your 401k, so there's no interest that you necessarily have to pay back. It does not use that 401k or stocks as collateral as well. So instead, it's simply a movement or a change of the custodian of who's in charge of that 401k. So here are the terms for qualifying on it. Low rates, they're often less than 5%. Your 401k needs to have more than 35,000 in it. You can usually get up to 100% of what's rollable within your 401k amount. The lender will want to see a copy of your 2 most recent 401k statements. You can also use that 401k financing and rather than challenging on that personal credit account. The 401k cannot be used with businesses where there's currently employed. So back to that original, if you're currently employed and a current business is contributing, it doesn't work. So you cannot be currently contributing to it. So it has to be an account that typically is a 401k that's been seasoned or old. Another option for financing, and again, just as a reminder, with all these different options that are out there, These are listed again at creditsuite.com under business loan. I know we're kind of going over it quick because there's a lot of information. And I think my timer's telling me I've got about 10 minutes left. So I'll see how quickly I can talk. And is an IRA financing. This is similar to a 401k financing. In as little as 3 weeks, you can invest in a portion of your retirement fund into your business. This gives you more control over the performance of your retirement plan and assets, and it gives you the working capital you need for business growth. Terms for qualifying: in general, you'll work with your CPA to directly do that, your certified public accountant. They'll help you roll over the non-contributing and qualifying account. It allows for cash out options or up to $50,000, whichever is lower. If acceptable, your certified public accountant can work with structuring a self-directed IRA for the remaining funds. Stocks and bonds financing. I think we're on number 10 out of how many? I'm trying to think of how many we had in here. 14. So stocks and bonds financing. Some lenders will allow you to make loans against securities as collateral. So a security-based lending for a bond is offered through large financial institutions or even through private banks. People tend to seek out these kinds of loans if they want to make a large business acquisition. So unless you're coming into a startup company or have been existing for a while, this might not be an option that you have. I know it's not an option that I have. Or if they want to execute large transaction and real estate purchases. It also can be done with lenders determining the value of the loan base of the investment portfolio. Like in some cases, the issuer of the loan may determine the eligibility based on the underlying assets of what you have. It can end up being approved on a loan based on a portfolio of like the US Treasury notes rather than stocks. Some of the terms and qualifying on these is acceptable securities, which would include investment grade corporate bonds, treasury, municipal, or government agency bonds. You keep all the interest and appreciation from securities, and the rates can be around 1.6%. To qualify, all the lenders will require a copy of your 2 most recent security statements. As well as if your stocks or bonds have value over $25,000, you can be approved even with severely challenged personal credit. Closing and funding takes less than 3 weeks. Okay, angel investing. Angel investing, kind of in a quick nutshell, is in the past, people would often say, hey, do you have a rich uncle? So it's basically friends or family that you're able to go to and say, hey, I need you to be my angel to provide funding. There were more opportunities of angel investing in the past. We've noticed during this past year, things have switched around, and we expect that in the future there'll be more opportunities that are out there. But for informational purposes, this is what an angel investor really is. So an angel investor is an invest in startups or entrepreneurs. Oftentimes they are your family and friends. The capital they provide might be a one-time investment to just help you get initially started, or an ongoing injection of money to support or carry the company through early years. So a good example of this is my wife's younger brother wanted to open a business where he was refilling ink, but he needed some initial capital to get started overall. So my wife and I said, hey, let's give you some money. It wasn't in the form of a loan. It was basically, hey, we can work through it and give you that start that you need to get into your office and start going through it. So that would be an example of like an angel investing. So they're not covered by securities or the exchange commission, so they can be a little bit more risky because it's just between that, those family members or friends who are leaving it out, and it doesn't follow the standards for accredited investors. That goes down a rabbit hole of a different ever opportunity. If you haven't heard of what an accredited investor is before, there's different type of lending options that you can actually get into, but you have to be approved. And I think the current requirements to be accredited investor is you have to be able to show, I think, $2.5 million on paper and prior experiences with investing. And then it opens up other opportunities of type of investing that you can get involved with. I think most of us dealing here will have less than that, so we can just be following it under that angel status. So angels could be friends or colleagues, just sitting on basically home equity, or local professionals who are looking to invest. Consider people you know well and people you don't know so well. And keep in mind, you're giving up part of your ownership in the business to receive that funding. Now, that's when it comes to friends and family. The alternative is what the next one option, and that's more like Shark Tank, when you're actually trying to go in and pitch for venture capital. Venture capital is different than angel, but even though they're similar. So angel investing, so angels are informed investors, so they're really informal investors, so there really aren't any really terms. It's just between you. So technically, there's nothing done to qualify besides how well you can pitch your family member to give you money. So these investors probably should insist on the valuation of your business. You need to be able to give them some kind of business plan so they know what they're getting into. It's always a good practice to get everything in writing beforehand. So here's venture capitalists. So a good example of venture capitalists would come like Shark Tank. They're not angel investors, but they're more in a category of a venture capital where they want to turn around and be able to provide money in a venture capitalist and businesses and business owners to be able to see based on products and what their company's done. So a venture capitalist gives money to help build new startups. The venture capital believes the company has a high growth and high risk potential. They tend to be a fast-growing company with exit strategies already in place, and these venture capitalists are often looking to recover their investment within 3 to 5 year time frame. Another good example again is like Mark Cuban and those who are at Shark Tank. So just to give you an idea, so that way you can understand the difference between these, is they're really those venture capitalists. They're looking for these startup companies that they can make a great high risk capital growth on their basically betting on the product and service. So these venture capitalists will often want to have a piece of the property or the company, not property, if not a controlling stake. They want game-changing businesses, so their straightforward businesses won't be their radar unless they're shifting their paradigm. And like an angel investor, you are giving up a part of your ownership in the business. So if you've ever seen Shark Tank and you've seen different offers that the sharks will give, some of them will give them like an amount, percentage, ownership, depending, because they want to be a part of that venture and make the deal happen overall. But usually a venture capitalist will be a little more, they'll want more stake in the game than like your rich uncle in comparison to like angel investors. So qualifying, again, these venture capitalists, they're more informal investors overall. They're more formal than angel investors, but there really isn't any set guidelines based on if you're able to really pitch your product and service overall for the valuation. They'll look at specific terms to be spelled out in the agreement, but they are under the Security and Exchange Commission. They're all accredited investors as well. So best practices is to consult with like an attorney before you go in and look at a venture capitalist before signing anything. Unsecured credit cards, which we did briefly check the time. Unsecured credit cards, we briefly went over this earlier. This is where you're able to get a credit card approved, but it doesn't have to have a deposit. They are a little riskier to the provider, so they really can determine on your personal credit. So some of those qualifying factors would be what the APR is, if there's rewards on it. The better your FICO score and history, the better your approval rates will be, or even your higher limit amounts. Reward-based crowdfunding. These are other options that have been used in the past, and I believe they're going to become more prevalent here in the future as well. So you can get money from a crowd for your business, services like Kickstarter, where you can make sure you go through and understand the fine print of what's taking place in these crowdfunding platforms. It's basically an idea of pitching a product to the masses through social media, and people who like it will say, hey, I'm willing to give a little money, but you usually have to give something in return. Maybe it's a percentage on the donations. Make sure you know how they get the money, or you have to deliver your promise, your product at a discount, depending on whatever it is that you've pitched or you've promised to these initial crowdfunding individuals. If you're actually manufacturing a product or do whatever else your business is supposed to be doing. So given how much of social media are bombarded these days, you have to be concern, and it's no surprise that donors can become really weary now of crowdfunding pitches just because it's more prevalent than what it's been in the past 5 years. So some of them, crowdfunding tends to work best with donors who can personally connect with the product or services, be straightforward. Businesses may not do so well. The kind of businesses which do often associate with or products that are not quite on the shelf yet, artistic endeavors or standard widgets, will most likely not attract brand ambassadors. So if it's something that fits a specific niche that is unique, that hasn't really been seen out on the marketplace, they do better. Because crowdfunding campaigns are time consuming, it doesn't make sense to try this form of funding unless you realistically feel you have a chance of success is better than 50%. So understand that there's some time definitely involved. Terms will differ depending on which platform you use. Check and make sure your platform or choice will allow your industry to work with them. For an example, even though recreational cannabis used is legal in many states nowadays, some of the crowdfunding base like Kickstarter, for an example, does not allow funding for drugs, nicotine, tobacco. So you have to make sure that if you have a product that's in that risky category, that you're following the correct steps if you're looking at crowdfunding options that are overall. Most of that information you can look right on their website through their frequently asked questions to see if your particular business category reads that. Okay, equity crowdfunding. This is similar on crowdfunding, but this is where your stocks are being offered in the form of whatever product or service you're out here. So equity crowdfunding has been around less than 10 years. It's not the same as a reward based like Kickstarter. Potential investors visiting funding potential website. There you can explore different equity crowdfunding investment opportunities, and there's limits on how much capital an individual can invest based on their income and net worth. And the recent one that I saw on here is if any of you have seen the social media YouTube channel out there called Studio C. In the past, this is a comedy channel where they have family-friendly videos. It's kind of like SNL, but friendly for families. The original group went out and they created like their own program, and they were looking for equity crowdfunding to launch a television show, kind of a comedy television show where you could actually put a certain amount in and then you got equity in that television show as it grows. So that's an example that I came across recently that would fit this kind of category. Terms and qualifying, the equity crowdfunding tends to be covered by a Security Act, so you want to make sure you go through the regulations and laws that are on here. Federal laws can be complex, so you want to make sure you have an attorney who understands these. Best practices, consult with an attorney, absolutely, when it comes to this. Boom. Federal grants, which I think we're coming here to a close. Federal grants, these necessarily don't have to be paid back. They can be available for urban projects like the Housing and Urban Development, or rural projects like the Department of Agriculture. Federal funding means paperwork. You often must show experience before you're able to get that approval for a grant. Here's a resource that you can go to, grants.gov, to be able to go through it. Qualifying kind of has varying qualification, depends on what industry you're in, and they can be very competitive as well. So you want to make sure you check through that. An example of this, for an example, is my wife runs and owns a home-based daycare, and they had some federal grants that were available to help improve your location with, toys and materials that can be used. It took her through a 6-month process with individuals coming out and checking the establishment, making sure things were working correctly. And this was done just through our local state. But at the end of it, they were able to get a certain amount of money to basically purchase toys and equipment, things that can be used specifically for that business, which was greatly helped, but you just have to put the time and effort in to get those approvals. These are the local and city-state grants and how to partner up. So some of these qualifying, like federal grants, check with the requirements and other information carefully. You might need to be a resident of that state, or the business need to be headquartered there, but it never hurts to ask. Ooh, I missed on this one. SBA microloans. An SBA microloan is a nonprofit community-based organization organizations with experience in lending as well as management and technical assistance. The Small Business Administration provides funds to specifically designed intermediary lenders, and these intermediary administrators are microloans for eligibility borrowers. This helps small businesses and certainly non-profit childcare centers to help and expand. So some of their qualification processes can be loans up to $50,000, average microloans around 30. These are similar to like these grants that can become, but there's a payback period on these overall. Generally, these require some form of collateral as well as the personal guarantee of the business owner overall. Awesome. Microloans in here as well. It has relatively low interest rates. These are loans offered to small and developing business loans with capital requirements, little to no revenue history. There's the name as it suggested. They're just small business loans on comparison to traditional bank loans. Some of their qualification, term and requirements may vary. For an example, some out there, Kiev is one for an example that I'm not too familiar with, but here I think it's at a 0% interest. Opportunity funds provide loans for low or moderate income immigrants, women, or other underserving small business owners. Here we go. So the recap overall, made it within the hour. For those who stuck around, thank you so much for sticking around. Going back to around that foundation, we started off first in the first 15, 20 minutes talking about the foundation of fundability, making sure your company looks and operates the way a company look and operate. Then I think we went through about 15 different funding options that are out there that you may or may not be available with. Definitely, refer to creditsuite.com under business loans, and these different options are there with more information and even how to get in contact with us if you're looking for business funding option as well. We can open up that channel with our funding team on how to be able to get these funding loans for your business. The three categories of the 3 C's, looking at that collateral, cash flow, or your credit overall. And if you have additional questions, here's our direct number here, or feel free to email or contact us directly through Credit Suite. Once again, I greatly appreciate you attending and being a part of this webinar. I apologize that it had to be so quick. There was truly 2 hours of information that was crammed within an hour time frame. So thanks for sticking around. Normally I would stick around and go over questions that are in ours, so I apologize on that the time has been spent or short. But please join us and continue to watch us online. Thank you again, and have a wonderful afternoon and a wonderful time. Thanks, guys. Have a great day.